This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. Will stocks get even cheaper? Are you on the sidelines waiting? I'm not a big fan of market timing. It's almost impossible to do well. However, many of us are sitting on a little bit of cash right here in September 2022, almost going into October, because we think there might be another leg down and we might be able to get some things even cheaper. But remember, it's always wise to have a plan. That's what will make you a better investor. Stock sell-offs aren't too scary if you have a plan. So for some of you, that might mean, hey, I can't take these losses in my portfolio and I want to put some stops in. So, and a stop, remember, means if your stock hits a certain level, that's your stop, then you sell and get out. Some people like this because it contains the losses. Now, other people are longer term investors. They don't really care if it goes down 20, 30, even 50%. Because they're going to own it 10 or 20 years from now. So for those investors, it might be wise to say, turn off your phone right about now, especially if you've got your portfolio on there, turn it off. I don't have my portfolio on there, my own personal portfolio, but I do have my Zacks portfolios on Yahoo Finance. And I was on vacation last week when we got a bigger sell-off in the market. And one of the mornings, suddenly my phone was vibrating. I don't even have the, thing turned on, but it does vibrate whenever there's an update from one of the apps. And so suddenly it was like, kept it vibrating. And I'm like, what's going on? Is Pinterest sending me like a ton of updates or something? What's happening? And I look on there and I was surprised to see it was Yahoo Finance, but it was on that Friday of the worst selling. And I took a look on there and suddenly I see like a dozen or so messages, of the stock tickers hitting 52-week lows. So it was like one after another, 52-week low, 52-week low, 52-week low. It was just sending me these updates. So if that gives you anxiety, get it off your phone. Don't even have Yahoo Finance on there, right? I don't have any of my own personal portfolios anywhere on my phone. I don't even have the apps of the companies that I do, have my portfolios. None of those are on my phone. I make it real hard to go look at my portfolios. That helps me control my emotions and any kind of anxiety. So that's one suggestion. And otherwise, if you are a long-term investor, remember, you hopefully own some great, solid companies that can ride it out, ones that have been around forever. I mean, think about how many sell-offs a McDonald's or a Home Depot or some of these companies have been through, or Union Pacific. That's one of my favorite old-time companies, the railroad, UNP, that ticker there. They've been around since 1860s. And they've been publicly traded seemingly for forever. So they've been through the wars, they've been through assassinations, the Great Depression, the Great Recession, all this stuff. I'm not saying the company will survive forever whatsoever, but their stock, their management teams have been up and down through all these curveballs in the global economy and the U.S. economy over all those years. And so that is what it takes to have a little bit longer term perspective, right, on some of these companies. And so own companies that you know what's going on, you know what their business model is like, and it doesn't give you anxiety. If it gives you anxiety, you might want to think twice, and you might want to, rethink your plan, because that's what it's all about, having a plan. But for some of you, you may want to deploy some of that cash. If we're all sitting on some of it, we're going to have to put it to work at some point. And maybe you do see some deals out there right now. Some stocks are dirt cheap right now. And so I thought I'd take a look today at what are the highly ranked but cheap stocks. I know they're out there because we're not having any trouble finding value stocks anymore, right? Value is in. Many are dirt cheap with even single digit forward PEs. Even if the estimates get cut, they're still cheap. So this is the time. This is our time. And we are seeing some deals. Now, I don't know if you're like me, but I'm getting a little bit greedy about getting the deals because I do think maybe we might see another smaller leg down still to go. So, but dollar cost averaging is your friend. Nothing wrong with that. Again, market timing is very difficult. It's very difficult to buy exactly at the bottom of anything. And that's okay. If you're a long-term investor, you don't need to buy it exactly at the bottom. You need to buy when it's cheap. And a lot of these stocks are cheap. So I thought I'd take a look at a little bit different screen this week. And this one combines the Zacks rank, the Zacks style scores with the PEs, the PEGs, and the industry rank. So these are all like all of the Zacks rankiness and all of its products to try to find companies that are outside the mainstream, basically, outside of the trends. And the trend right now is negative. So these are more the bullish side of the trends. So these are Zacks number ones, which are the strong buys, and number two, which are the buys. That hopefully means earnings estimates are on the rise. Then it includes the Zacks style scores of A and B. Those are the top two style scores. So if you have a Zacks rank of 1 and a style score of A, that's pretty darn good. Now, what does a style score even mean? That is a ranking system where you get so this is for value, these style scores for value. We have it for growth and we have it for momentum. And they combine a whole bunch of the criteria into the style score. So, it combines like PE, price to book, things like that. That would be value indicators into that style score. So this is real kind of crazy value if you have an A or a B, and then you have the rising earnings estimates with the high Zacks rank. Also has a PEG under 1. So we might as well throw in some growth in there along with the low PE. And it has PEs in this screen under 20. That's to give it enough room because there's a lot of value already built in. But PEs under 20. And then it also combines industry rank under 50%. So, that would be like the top 50% of the industry rank. And hopefully that also is tied into the Zacks rank. Usually the more companies in an industry that have the high number ones or number two ranks, the higher it ranks on the industry rank. So that would all tie in as well. So lots of rankiness in this screen. I had no preconceived because over the years as I've run these, a couple of years ago, we used to get almost nothing on some of these screens because there just wasn't anything cheap enough, or it didn't have like the growth or something was amiss. But now, as I said, we're having no trouble finding good quality companies that are cheap. This is our time. And this screen returned 42 stocks. So I was just kind of perusing it before I came on today to do this podcast because it's a lot of fun to look at a bigger list, but you also can get a little bit overwhelmed. Like, which ones do I choose? There's 42. That's a little bit too much for me. So, of course, I pulled out 5 in different industries just to give you some, oversight into what is on this list. A few are ones we've talked about in the past, of course, because if they were cheap, a couple months ago, they're even cheaper now. And some of these have just had the good profiles all throughout 2022. But I picked out a couple that we haven't talked about for quite some time. So that's interesting. And what I thought would happen during this pullback is that some stocks that usually are in the value camp but got too expensive during the pandemic have now pulled back and now they're in our wheelhouse again. So these are the types of stocks you want to keep on your short list or your wish list, your watch list, whichever thing you call it. And, these are the types that you can start to enter into because they've gotten so cheap and they are on your list. So let's dive right in and see what's going on. So the first stock is Centene. Haven't talked about them in a long time. Health insurance, ticker CNC is their ticker. They are number 2. And interestingly, for some reason, I picked out all the number 2s. That's the buys. But that's fine. But I picked out all the number twos today, not on purpose. That's just kind of what happened. So Centene, number two, it does not pay a dividend. So for some of you, I know you're looking for the dividends now. That might be a deterrent. But PE is just 13.6, PEG is 0.95, and year to date, they're down, but only 4.9%. So some of the health insurers have been kind of a place to hang out and hide out. So they haven't seen quite as big of a pullback as some of the others. But in this recent little mini bear that we're having again, it has pulled down enough to be negative for the year and has gotten cheaper. So that's Centene on the health insurance side, ticker CNC. C as in cat, N as in Nancy, C as in cat. Second stock is Diamondback Energy, ticker F as in Frank, A as in Ann, N as in Nancy, G as in George. So the original FANG stock, Diamondback Energy, we have talked about them in the past. They are oil, natural gas, one of the explorers, commonly called the E&Ps. So they go out there and drill for the energy. And they're dirt cheap. They're the cheapest out of the five today. PE is just 4.4 as those earnings remain elevated with higher crude and natural gas prices. PEG is just 0.2. Dividend, 2.6% is what we have, but there could be some specials in there. I'm not sure what Diamondback is doing, so always keep that in mind with any of the energy companies, but 2.6 on the base dividend is pretty nice. Year to date, these shares are up, but they're up 9.3% only year to date because a lot of the energy stocks have pulled back after crude fell under $80. So there's could be a buying opportunity in some of these energy names once again. So that's Diamondback Energy, FANG. And then we have Kroger on the grocery store side, ticker KR. I haven't talked about them in quite a long time. They too are pretty cheap here. PE of 11. PEG is just 0.94. Year to date, they're down now. They were one of the ones holding up. It was kind of one that everybody was hiding out in as well because we're all going to the grocery store and we need food, obviously. And so this is an area you can kind of hide out in. But year to date now down 0.4. So it's, just a little under that flat line there year to date. And dividend is now yielding 2.4%. A lot of people own Kroger for the dividend. If it falls further here, it's going to be, even more interesting, a little more juicy, but pretty cheap here, even as it is. So that's Kroger, ticker KR. And then I threw a bank in there. There were a number of banks on the list. This one I picked out because it used to be the troublemaker of the big, big four banks. And it's Wells Fargo, ticker WFC. Haven't talked about them in many years, really, because they've had all those issues. And so they were the out of favor bank compared to Citigroup, Bank of America, and JP Morgan. So Wells Fargo on this list, PE now is 10, PEG is 0.98. Year to date, the shares are down 15.1 because the banks have pulled back, which doesn't make as much sense because rising rates should help. But Wells Fargo is one of the biggest mortgage providers out there. And the housing market is, halting, seizing up, as I call it. And so sales are way down, not as many people getting mortgages. A lot of mortgage brokers have been laid off because nobody's refinancing. So a lot of those issues around it, but still cheap. And if it falls further, will get cheaper. So that could be an interesting story. You do get a dividend and it's yielding 3% now, again at Wells Fargo. So that's ticker W as in William, F as in Frank, C as in cat, WFC. And then I'm going to wrap it up with one of my favorite companies. I used to own this in my own personal portfolio, but I sold out of it years ago. United Rentals, ticker URI. This one is equipment rentals. They're the largest in North America. And so whenever the economy is seeing a lot of building, say on infrastructure and things like that, United Rentals is somehow involved. They're also lease out equipment to big construction projects. Strangely, I was just in New Mexico on vacation, and I was at a national park there, and I was on one of the shuttles, that takes you from the visitor center down into the main park. And we kind of stopped at a weird location, like just on the side of the road. And a worker got on, but he had on like the construction type of clothes. And on the front of his little jacket, it said United Rentals on the jacket. And I was like, what is the United Rentals guy getting on here in the middle of the national park here? So I was intrigued, but that's the thing with United Rentals. Once you start paying attention to the name and the company, you kind of see them everywhere. You'll be like, driving down and you look over and there's some crane or something is going on over there, and you see some equipment and there's the United Rentals name like just on the side. Trust me, you'll start to see it once you start looking for it. But that's my point. United Rentals, they're everywhere. And I like this play on the infrastructure. The U.S. just passed a big infrastructure bill. There is going to be spending. They're rolling out those charging stations. I'm not saying United Rentals isn't going to be involved in that, but there's a lot going on in this realm in their area. So I'm liking it. Year to date, shares are down 17.5% now. So they've gotten much cheaper. And PE is just 8.3, PEG of 0.47, no dividend with United Rentals. So keep that in mind. It is one thing I didn't really like in the years I owned it. I wish they did pay the dividend. They might have a share buyback. You'd have to check. I haven't looked in a while with that one. But I kind of like getting the dividends. That's a fun thing for me. But still really like the company. That's United Rentals, URI. So you can see all of these are cheap. I had my screen for a PE under 20. These five in particular didn't even get close. The highest one is Centene at 13.6. So even if I had screened for 15 and under, I'm still getting these five stocks. And then I'm kind of just expecting now, because everything's so cheap, to see a bunch of stocks at like 8 times, or even the 4 times for Diamondback doesn't really even shock me anymore, even though it should, because that's really cheap. Some of these are a little more cyclical, like the energies. So the earnings will go up during the good times and then they'll come down. So some stocks may not be quite as cheap as you think. But right now, these stocks are this cheap because the earnings aren't coming down in a quick manner. And with some, like energy, they're actually going the other way. They actually are still on the rise. So a lot of good things out there for us value investors. So that's one good thing about a stock market pullback, even though we all hate it in our portfolios, because all of our portfolios are down right now. But it is a buying opportunity for those of us who have some cash, even if it's just little amounts, to deploy, or if you're dollar cost averaging into, one of the major indexes, you are getting it on sale. And remember, I always say stocks are the only thing that us humans do not like to buy when it's like 20% off, right? We'll buy anything, when it's discounted down. Heck, even like 5% off. We're like, what? 5% off? Sure, that's a deal. But stocks down 20 or 30, and we don't see the value in it for whatever reason. It's an interesting psychology, right? But now is the time to, be looking around for some of these deals. Keep your watch list. Have a plan, and enjoy being a value investor during this time, because we always complain when things are not cheap. So now is our chance. So there's no complaints here. That, plenty of companies are cheap, genuinely cheap right here. And now is our time. So let me recap the stock tickers again. We had Centene, ticker CNC. We had FANG, that's Diamondback Energy, FANG. We had Kroger's, ticker KR. We had Wells Fargo, WFC. And then we had United Rentals, URI. And that's it. So be sure to subscribe so you don't miss another single episode. There's plenty of value stocks. I'll be bringing them to you every week. here at the Value Investor Podcast. And as always, you can also get the Zacks Market Edge. I'm bringing you stocks there too. But be sure to get them somewhere, and I'll see you next week with some more value.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.